Analysts citing the interest rate decision of various central banks as a possible reason. Yet the overall environment for the oil market seems to still be characterized by a tight supply side, while the demand side tends to remain uncertain. We make a start, as usual, with the data for the US oil market in the past week. We note that the Baker Hughes oil rig count continued to rise and showed a number of 515 active oil rigs in the US, implying that the demand is on the rise. It should be noted, though, that the number of active oil rigs, despite rising slightly, is still a far cry away from the number of active oil rigs in the US about a year ago. Furthermore, the API weekly reading indicated that US oil inventories have dropped by minus 5.250 million barrels, while EIA also reported a drop in oil inventories, yet a lower number of minus 135 million barrels. Despite the divergence in the figure, the common part of the two releases tends to imply that oil demand was able to surpass production levels, implying a relatively tightness in the US oil market. Should that status be maintained also by next week's reading, we may see oil prices getting some support. On the demand side of the oil market, we note the argument on whether global oil demand is to peak by 2030 or not. Yet for the time being, we view such a scenario as too far off to affect oil prices. Market focus tended to be on the release of a number of interest rate decisions this week, starting with the Fed. The bank maintained rates unchanged as was expected, yet also implied that another rate hike could be delivered. Further down the line in markets, expectation for rate cuts in the coming year were too high. So overall, the bank's restrictive level of monetary policy is expected to remain for a prolonged period, something that may have an adverse effect on economic activity in the US and thus on oil demand. The market may have been expecting such a release by the Fed, at least partially, and that may have forced oil's price lower. Should that expectation continue to grow over the coming days, we may see them continuing to weigh on oil prices. Across the world, despite seeing some positive signs regarding China's economic recovery, the big picture still is being characterized by uncertainty, which in turn may also weigh on oil prices. On the other hand, the outlook for a tight supply side, characterized by OPEC's low production levels, is being maintained and may have clipped the drop for oil prices in the past few days. Yet, it's not only OPEC and its allies, also US shale oil producers have started to lower production levels over the past 2 months and is expected to fall also in October. The issue is reported to be even more intense as crude output in the Permian Basin in 5.773 million barrels per day, the lowest level since April as reported by Reuters. The news may have created some doubt about the possibility of US shale oil being presented as a partial alternative to the low production levels of Saudi Arabia. Despite EIA's prediction that the production is still to reach record high levels in 2023 and possibly to be exceeded in 2024, such worries may support oil prices. Even with current numbers, the news tended to display a rather muted reaction of shale oil producers to the increase of oil prices over the past month. Overall, we tend to see the persistence of low production levels as being more consistent and may in the future, if not the coming week, be able to provide renewed support for oil prices on a fundamental level. Thank you for watching.